Thanks for joining News 6 and clickorlando.com. I'm News 6 anchor Lisa Bell, and we are talking about the stock market once again today because unfortunately stocks are down again. We've been on a roller coaster ride lately, and it all comes as some economic concerns grow. So joining me now is financial expert Lee Seiler, known as the Stock Doctor, who is based in Central Florida to talk about what is happening right now in the market. Thank you so much for joining us. You are known as the Stock Doctor. So give us first a little bit about some information on your background.
Well, I've been doing this over 37 years, so I've seen all types of market climates. So when I see something like what's going on in the last 21 days, I'm not that concerned because you have to decide whether something is your garden variety correction or is it something more substantial like a bear market. And, Lisa, one thing that investors get spoiled, and we haven't had a 10% correction in 16 months. And by the way, based on history, a 10% correction happens on average every 16 months. So this is what happens. And I think that a lot of this is intentional. I believe that administration, they said, yes, look for some short-term pain. They want us to feel it.
Okay, and you mentioned the term correction. We now, it's my understanding, are officially in correction territory, at least when it comes to the S&P 500 and the NASDAQ. And you say that's normal, nothing to be concerned about, but a lot of people are concerned that this is going to last for quite a while and we're going to continue to feel pain.
It never feels good. And history tells us that 10% corrections last about 120 days. So if that's the case, we have 3 more months left of this. But again, understand that if you are an investor that is in retirement or near retirement, you probably shouldn't be that much exposed to the market. And, the question we have to ask ourselves, and nobody really knows the answer, but are we in an economic slowdown or are we heading towards a recession? So I don't think the administration wants a recession, especially going into midterms next year. But an economic slowdown is certainly in the cards because there's no secret. The administration wants lower interest rates, and the Fed is on pause right now, and nothing gets rates a little bit lower than a slowdown in the economy and the stock market going down.
We hear this term recession being used more and more lately, but there's a very specific definition when it comes to recession. Tell us about what exactly is a recession, what that means.
Well, it has changed over the years. It used to be 2 negative quarters of GDP, which we saw this a couple of years ago, and we never recessed. But now it's really that 2 quarters of negative GDP, but you want to see unemployment spike. Of course, you're going to see some of the public sector jobs and the jobless claims go up there, but the private sector is still pretty much hanging in there. So we're not seeing a lot of job loss, and that's really a key component to a recession.
You mentioned inflation. We just got the consumer price index data for February. The numbers were better than some people had expected. Egg prices still sky high. What does the future look like? What do you think the outlook looks like when it comes to inflation?
Well, there are pockets of inflation, and part of it is, I think, wage inflation is probably not going away. The fact that we have raised the minimum wages so many times over the last several years. So that's here to stay. And the tariff, which is obviously the big buzzword these days, you hear tariff this, tariff that. That's certainly not good on the inflation front. Tariffs are basically a tax. And if we move forward with this and continue on with the 25, 25, 20, that's going to be a problem for obviously goods coming into the country. Now, as for eggs, we can blame the bird flu, blame whatever, but it is ridiculous what we're paying for eggs.
When we talk about inflation, one of the things that kind of stuck out in that report that was released yesterday was the shelter index, and it appears that prices for rent are coming down a bit, which is certainly potentially good news for people in Central Florida.
Yeah, they have to. It's almost unaffordable for a single person living on their own with a moderate wage. It's almost impossible. So, what you're going to see is that people are staying maybe longer in their parents' house, so they're not renting. And, there are more rentals out there vacant these days. And that's what needs to happen so that the landlords say, hey, you know what? It's not what it used to be a couple of years ago. We have to lower these rents. And, mortgage rates going down will certainly help that as well. People that bought properties in the last couple of years, they bought them obviously at higher rates, and if they're financing them. So if there's a refi cycle in mortgages, that's certainly going to help, but we need rates to go down for that to happen.
On the flip side, I've talked to some people who've recently purchased homes, and they're concerned that if housing prices start to fall a little bit, they're going to be underwater in their home. And of course, a lot of people,
Yeah.
were around in 2008 and remember the housing crisis. Could we see something like that again?
I don't think so. I think that the banking system is a little bit more prepared for something like that. I do see certainly home values going down a little bit. I can see that happening, but there's still a huge demand and there's still a housing shortage. So, I think that yes, housing prices could go down a little bit, but if rates go down, when that happens, you see mortgage applications go up. So I think that's kind of a double-edged sword. Yes, prices could go down, but if rates go down, that'll probably stabilize prices.
And it truly was on an unsustainable track. I mean, when you look at the
Yeah,
percentage of increase in housing prices versus
it's
wages,
crazy.
I don't know how people can afford the houses that are on the market.
No, the new home buyers are certainly in a predicament because anything decent in a nice area is going to cost you $500,000. So that puts your mortgage at around $3,500 a month. That's ridiculous. I mean, rates going down will solve a lot of that, but that's going to take time. Rates aren't going down overnight, and luckily over the last few weeks, we've seen some slowdowns in certain areas, and now there's talk the Fed may cut rates 3 times this year as opposed to maybe 1 time. That was the talk about 3 months ago. But even though when the Fed cuts rates, that doesn't mean that mortgage rates go down. Mortgage rates go down if the 10-year Treasury yield goes down. So a slowdown in the economy gets investors nervous. They start buying bonds, and then bond yields go down because there's an inverse effect between bond prices going up on the buy side when you're buying and yields going down.
So if the economy continues to perhaps worsen, would that you're saying would help mortgage rates come down?
Absolutely, because when you see a slowdown in the economy, the 10-year Treasury yield will go down because there'll be buyers in our bonds, and that is really what we're starting to see. I mean, bond rates did drop about 25, 30 basis points over the last month or so when we started seeing what was going on in the market. And I think that'll probably continue. Right now, we're seeing about a 430 yield on the 10-year Treasury. I think mortgage rates, 30-year mortgage, are around 6.5-ish, plus or minus a little bit. So that's better than the 7.25, 7.5 we saw late last year.
Let's go back and talk about that Fed rate that there's so
Sure.
much focus placed on that Fed rate. And when they cut the
Right.
rate, that really affects the interest rates on your credit card, maybe car loans, things like
Car
that.
loans, absolutely.
Yeah. But then what's interesting, though, is you talk about tariffs, which could potentially push prices up, raising inflation, if you will. And
Yeah.
as we've seen, as inflation goes up, the Fed doesn't really want to cut interest rates. So, I mean, they're kind of in a weird spot right now.
They are, but who knows if these tariffs will stick? I mean, look, the fact of the matter is, the rest of the world has had a free ride on us, and I think this president realizes that we no longer want to be the patsy anymore. I mean, think about this: the foreign vehicles that represent about half of our cars being sold in the United States, they get a free ride. They're not paying big tariffs coming in until now. So the fact, look, I hate that there's a tariff war. That's not good for anybody. But I believe that they think this is a bargaining chip and to get everybody to the table and say, let's make it more fair, because we've been paying tariffs for decades and decades. And, it's about time that we probably get a piece of that action.
We did receive one comment. Someone posted, RD said, the markets have been overvalued for some time. We're already in correction territory, down 10%. How much more do you think that they could go down?
Well, RD, that's a great point, because the market was over its skis for a while. Multiples and valuations were way higher than they should have been. So these corrections are healthy. They're painful, and they didn't used to be so swift. I mean, 20 years ago, when we see a 10% correction, it would take longer, but things move faster these days. So, yes, is there more pain? Probably, but I bet that we are really close to a dead cat bounce, at least some kind of 3 or 5% bounce from here over the next few days or so. I wouldn't be surprised. Again, I don't believe this is a bear market, which by definition is 20% or more. I don't believe so, because we really need a recession to do that, or high unemployment. So I don't see that in the cards, but certainly the Nasdaq's down 14%. All right. The S&P just hit 10. So we're getting close, I think. And some of these great tech stocks have been even worse. They're down 20, 25, 30%.
So we hear in times like this from so many financial advisors and experts, don't panic, don't make any rash moves when it comes to your money. What are you telling people to do? Just watch your portfolio drop,
Yeah.
watch your balance go down? What's the advice you're giving to people?
Well, I tell people don't look at it every day. That's first and foremost, because you really, at this point, selling is not the right thing to do, because you're kind of selling and closing the barn door if the horses are already out. So I wouldn't do that. But in the meantime, you should look at your portfolio. I mean, we institute protection in all of our portfolios, and it's some sort of protection in some way. And I'm not going to disclose our secret sauce, but everyone should have something in their portfolio that doesn't go down when the market goes down, whether it be a bond fund, whether it be a precious metal, something that doesn't give you 100% correlation to the stock market.
Okay. I know that you've spoken in the past quite extensively with our Justin Warmoth. He says you're always good for some stock
Right.
tips. What sort of
Okay.
investments are you looking at right now?
Well, I mean, I don't want to name specific stocks, because some people out there, it's not appropriate to buy individual stocks. But I believe that if you go out and start looking at things within the NASDAQ 100 that has been absolutely bludgeoned, like I said, there are stocks down there, quality companies that are down 20, 30, 35, 40%, that were just at all-time highs. And what has changed? I mean, there are companies out there where tariffs do not affect them. So if tariffs do not affect them, why are they down 20, 30%? So I would look there. Then I would look for other things that maybe have been, for example, some retailers out there. I mean, there are, and I'm not going to say this is a buy, but I look at things like Home Depot. Home Depot has been absolutely bludgeoned. I mean, unjustly, in my opinion. Now, it's never the cheapest stock, but I'm seeing here the high of 434. Now we're sitting at 347 on Home Depot. If I was somebody who can take individual stock risk as a viewer, if you can take that kind of risk, maybe you look at something like that to add to your portfolio. And I feel comfortable talking about something like that. I mean, tech stocks individually, it's a whole different animal, a lot more risk involved, but certainly they can call the office and I can give them some ideas.
We hear so much about AI lately and AI stocks, and potentially AI stocks being similar to like the dot-com bubble of
Right.
the late 90s. Do you see AI stocks as being like that, or maybe the wave of the future?
I think both. I think they are a wave of the future, no doubt about it. I'm a believer. But they also got way ahead of its skis. I remember back, I had a nationally syndicated radio show back in 2000, and anything with the .com, people got excited about. And these stocks, a new issue would come out, an IPO with a .com would double in the same day. So we're not seeing that kind of action in AI. We did see similar action, and a lot of those don't have the backing. They don't have the financials behind them. They don't have the earnings or the revenue. Remember, what typically drives stock prices are profits and sales. And, I would stick to the big companies that have a track record, because the smaller ones, yes, you have a lot more bang for your buck. You have some alpha there, but you also have a tremendous risk. And a lot of people can't take that kind of risk. A lot of people out there say, okay, I want to be a stock market participant, but when they see their 401k down 30%, they're devastated. So if you can't take the heat, you got to get out of the kitchen somewhat. So don't be fully exposed to the stock market. Add some of those other things that are non-correlated to help balance the ups and downs.
One of the most popular investments for a lot of people, especially young people right now, is crypto. Can I get your
Right.
thoughts on that? And people feel like in these times when they see the stock market dropping, I mean, Bitcoin is down, from
Yeah.
its high of over 100,000. But what are your thoughts on that?
Okay, I don't want any millennial hate mail,
Ha!
but I'm not a huge fan of crypto. Okay, we deal with clients that are pre-retired, retirement age for the most part. I have a multi-generational staff here, and they are well more versed in crypto than I am. I like things that are going to be there when it's time that I need the asset for income upon retirement. And I never tell anybody out there not to speculate. All I say is that understand what a speculation is. If you want to own crypto or any kind of crypto, Bitcoin, Ether, any of those out there, go ahead, but make sure it is a speculative part of your portfolio. If you have $100,000 or $10,000 and say, okay, I can afford 1% or 5%, because you can get a total loss in those. So you have to assume that that's going to happen, knowing that, hey, you have potential huge upside.
Yeah. And what should the percentage of your portfolio be on those speculative investments?
Well, it's different for smaller accounts to larger accounts. I know, my children are millennials, and I talk to a lot of their friends. And let's say they have a little $20,000 portfolio. Sure, they can have $2,000-$3,000 in crypto as a fun thing, knowing that it can go down to 1,000 or 500, but it can go up to $6,000 or $8,000. I certainly wouldn't want to do more than that. If you are a larger investor, certainly 1% to 2%, and there are ways now to invest in crypto with some protection, and that's things that we are looking into as well for our clients.
All right. Stock Doctor Lee Seiler, as always, we appreciate your great advice. And hopefully
Thanks,
we're
Lisa.
told toward the bottom of this pullback in the market.
Listen, the markets are way oversold, and I think we're getting close to some semblance of a low.
All right. Sounds good. Thank you so much for joining us this
All right.
afternoon.
Thanks, Lisa. Bye-bye.